But welcome to tonight's live stream. This is the first of 4 episodes where we'll be talking to Drew Meredith from Wattle Partners Financial Planning. Drew, how you going, mate?
Pretty good. Yourself?
Pretty good. People will know you from the Australian Investors podcast, which we co-host. They may even know you from any of the businesses that you run or co-run or have founded, which there are numerous. But for folks that are new to you and the Wattle Partners brand, can you just tell us a little bit about what is Wattle Partners and how long have you been doing it?
Personally, lifetime financial advisor is probably the best way to explain it. So been in the industry for about 17 years. Mm-hmm. Wattle Partners is the second iteration of what was originally the first fee-for-service independent financial advice firm in the country. Yep. Founded by a guy called Austin Donnelly back in the 1970s, I believe. Cool. It was sold in, I think, around 2010, and my business partner, Jamie Nemesis, and I founded again in 2010 as Wattle Partners with all of the same key messages or key traits that we focused on, which was, providing transparent advice, being completely open on fees, refunding commissions, all the things you'd expect from an advisor.
But that was pretty rare at the time, I imagine.
Yeah, it was a big differentiating point throughout the 2000s until 2010, and then a lot of regulatory change means that's the base requirement, as it should be for most advisory firms.
Yeah. So you've been doing, like we obviously talk a lot, you've been doing this for 17 years, right?
Yeah, 17.
17
A lot's changed and a lot stayed the same, I think.
Yeah. You primarily work with retirees or near retirees, right?
Yeah, so we're like every business, we've evolved over time. And most people get into financial advice because they want to help and they want to help everyone. Yeah. But over time, I guess as you grow up and your time gets more limited, you work out where you can add the most value to people. And we found that there's a lack of specific focus on dealing with the emotional and the change of investments required to rely on a portfolio of assets to deliver an income in retirement or just a passive income in general. Yep. It's very different to, a young person saving aggressively who can make mistakes and make up for it over 50, 60 years.
Absolutely.
Yeah. Once you retire, you've got a finite pool of capital and you want to extract as much as you can and protect it at the same time.
Yeah, fantastic. Well, it's great that you are doing this series with us for Selfwealth. Wattle Partners is a sponsor of Selfwealth, the first true sponsor of the show. So I really appreciate you coming on and sharing it with us, mate. You can get in contact with Drew and the team at Wattle Partners. I'm sure there'll be a link in the description, or you can head to wattlepartners.com.au/contact. But we're going to be covering a 4-part series on passive income, which is what the Selfwealth community voted for. We've done similar things before, so that's why I think this would be a natural and awesome fit for us. But we will be doing basically an open mic Q&A on the 25th of January. This will be where we'll be live and you'll be able to ask each and every question that you have about passive income, whether that's portfolio construction. We're going to do a few case studies and things like that, which will bring out a lot of the questions that you might have over the coming weeks. But if you do have some lingering questions, I highly encourage you to write them down and to send them through to us that night, because I'm sure this is going to be probably one of the most popular series we ever do. So just to give you a rundown of what you can expect from Selfwealth Live, we will be doing this introduction to passive income today, where we'll talk about a bunch of different things. How do you construct a portfolio, how Drew thinks about it for his clients, and what we can take away from that. But then also in the second installment on the 11th, we'll be talking about basically like how do you actually do this. We'll be going through 10 different stocks and ETFs or funds. They're not just ETFs that help people construct a portfolio that's designed for passive income, but also still captures growth and is sustainable in the way it goes about capturing that income. In the third installment of this series, we'll be talking to Drew about a fictitious example that I've given to him where there is a couple that is approaching retirement and is really keen on earning, say, $80,000 a year in passive income from their portfolio, which I was surprised about this, Drew, because I went through this with you with my in-laws, and I was surprised a lot of people don't realize that they can do that.
Exactly.
Do you find that that, like, not maybe not the 80, take the $80,000 figure out of it, but do you find that a lot of people do come away thinking, I didn't know that was possible?
We tell a lot of people they can retire now when they come in.
Oh, really?
Just through, and a lot of people don't realise the biggest period of your savings comes from like 50 onwards. So you have this period in your 30s and 40s where you have a heap of expenses and you kind of track sideways.
Kids and that sort of stuff.
And that's when people get the most worried. But then from once you get to about 50 or so, the savings capacity increases significantly for most people. And we meet a lot of people and a lot of the time we get to provide them with good news, which is that they can probably retire at the moment and achieve their goals, assuming their goals or their objectives or the income they're telling us is true, that it's possible. And then they go back to work the next day and they know they don't have to work, and working becomes fun, or it might be a career change, or that kind of burden of paying the bills starts to disappear, and they start to the emotional stress starts to get released. I
know we've had this conversation before, but I know some people that have come away from seeing a financial planner crying because they're so happy. They're so happy with what they have achieved. Like they don't
realize. Do that in front of us, but
it's more celebration in front of you, I hope. But a lot of people come away just like they're just astounded that they can actually do this. And I think that's because we've got this mantra where it's drummed into us to save. And then all of a sudden you're like, well, I've done a really good job. I've compounded. I've done all these things to grow my wealth. And there are so many levers that a financial planner, or just even being aware, if you know it yourself, you can pull low-hanging fruit that really changes the game for people.
Definitely.
Yeah. So obviously when people invest, the thing that people want is they want growth and they want income.
Yep. There's the old saying that I plus G equals T. So income plus growth equals total return.
Oh, yeah.
And
I haven't heard that before.
You haven't?
That's a new one.
But it's income and growth, not one or the other. And they combine together to get total return. And if you have all income, well, you're not growing. If you have all growth, you struggle to generate income. So
I'm going to use that from now on. I hope you don't mind.
And we kind of look through every investment through that lens.
Yeah, okay.
Which parts are contributing to?
Yeah, right. Whereas a lot of people probably don't think about that. But we're going to be talking about this in the 4-part series. We're going to focus mostly on the income, but as Drew goes through this, I'm expecting that he'll talk to making sure it's sustainable and that there isn't the other component, as you just said, the G.
Yep.
So why don't we start with the real basic question, which is what is passive income and why is it important?
The easy question.
Yeah.
A passive income is just income you don't have to work for. So it could be from anything. You could own a business that you're not working in that's paying dividends to you. It's investing in using capital that you've accumulated to invest in other income producing or return producing assets. Could be shares, could be bonds, could be term deposits, could be businesses, could be property. Just anything you don't physically have to work for. And it's incredibly important, I think, the income part of it, because growth isn't as predictable as income. Even during the worst crises, you still see some level of consistency of whether it's dividends or interest, or whatever it happens to be. Income is always more consistent. And it's something we stress during crises, that particularly for retirees, that the income is continuing.
So that's really interesting, because if we look back on, say, the last 5 years, probably the 4 years leading up to 2022 was all about growth. Everyone was like super low interest rates. There was still dividends were still a focus, of course, but it was growth.
Probably 10 years.
So true. Yeah.
I saw a group did some research into where returns came from in previous decades. It was something like 75% of returns in the 10 years to 2022, I think it was, came from capital growth.
70% from growth.
Globally, not just in Australia. So it's probably slightly different in Australia. And the most interesting part of that was that during every similar period in history, the following decade, income dominated returns.
Okay. So that could then, and this is that's just interesting because I took the 5-year lens here, but 2022 was a year that was characterized by lots of volatility.
Yep.
And kind of a flight to those safe stocks.
Yep.
So we saw that in Selfwealth Live. I think 3 of the top performing companies for the full year were coal companies, which maybe some people expected, but it was like a flight to energy security, cash flows, dividends, buybacks, those types of things.
Definitely.
And like you said, that is where people tend to go in a time of crisis. Like I think it's Warren Buffett's quote is like, it's only when the tide goes out, you see who's been swimming naked. A lot of these companies have been like,
which no one liked in the previous 2 years. So like 2020 onwards, it was all about tech and all about growth. And then as soon as it became a bit more difficult, the things like CSL, which may not be an income company, but it's a quality company that consistently grows. And then even the banking sector, the Woolworths, the Westfarm, the boring companies. Not that boring, but you know, they're not doing anything out of the ordinary. They're not expected to grow 10 times.
Yeah, well, you don't. So that's really interesting that you said basically 7 out of $10 comes from growth in that period that you looked at.
Yep.
Whereas historically in Australia, it's been a little bit higher for income.
We've viewed it the opposite in Australia.
Yeah, because of the franking credit system and what have you. I might just touch on a few points before we move on, which is that, like you said, you can get passive income from multiple streams, but there's this myth, I don't know if it's like an urban myth or what it is, and maybe it's just an online myth, that millionaires have multiple sources of income, whereas most people that haven't invested think about their job, what we call active income, as a form of income.
Maybe a side hustle and that's it.
Yeah, maybe like a little bit of income from something they do on the side or a part-time job or something. But most people who achieve financial freedom realize or recognize that you can basically get what we call free money from sources that are working, whether you're awake or asleep, whether you're at work or not. And those things are like property, the shares, ETFs, managed funds, superannuation, even cash in the bank, bonds, so many different things that you can earn this income from.
And a lot of people don't realize that until they retire and they have control of that pool of capital.
Yeah, superannuation in particular is your money. People don't think about that when they're in accumulation phase because they just think, I can't touch it.
It's a bit of a travesty, isn't it? That there's so much disconnect with superannuation.
Yeah. But we're seeing more people use things like SMSFs and like self-managed super funds and using, like I think in the Selfwealth community, even just as a really interesting thing, I could be mistaken, but I think there are nearly 4,000 SMSFs, which is incredible, using the platform to buy income-producing assets to fuel their super, which is quite really, really neat. But there was some other thing that for those people who are starting your journey, if this is the first Selfwealth Live that you've tuned in for and you're thinking, wow, this sounds really great, this passive income thing, I do want to stress a point that when you start, you're going to get $5 checks in the mail or $20 dividend checks or $100 or even...
Hopefully not in the mail.
Yeah, not in the mail anymore. Hopefully it goes direct debit into your Selfwealth account or into your bank account. And it might even be $50 or something like that. And at the time you think, this is nothing. What's this passive income thing Drew and Owen were talking about on Selfwealth? But over time, I heard it put to me recently that it sounds like a lot of money, but once you hit $100,000 and you've got a 4 or 5% dividend yield in your portfolio, that's $4,000 or $5,000 plus franking credits, which we'll get to.
Move the needle for a lot of people.
That starts to get serious.
Yep.
You know, if you average it over a year, it's $100 a week, and then you just keep compounding. It just keeps reinvesting, and then the flywheel takes off.
Yeah.
Now, so we've got different income sources. We've got shares and ETFs that pay dividends or distributions. We've got managed funds. Property pays rent.
Yep.
We've got cash that pays interest, like term deposits, savings accounts, those types of things. The one thing that's very topical at the moment, Drew, and one thing that share investors in Australia absolutely love is franking credits.
Yes, we love them too. I mean, majority retired or low tax-paying clients. Franking credits are a free kick for most people. I mean, there's a reason that the government talks about them every year and tries to ban them. But they tried to ban them, and I think the government or the opposition had no chance of winning because of it. But to us people in finance, they're incredibly simple. To everyone else, they're probably highly complicated. Essentially, franking credit is a credit for the tax that the company you own shares in has already paid. So when they pay you a dividend, that dividend will have franking credits attached to it if that company is making money. So if it's 100% franked, it means they're paying tax on all their profit. If it's less, they might have overseas earnings. And then you would include in your tax return the dividend plus the franking credit, but the credit is then used to reduce any tax payable. And that's important to understand. So if you're in an SMSF and your tax rate is 15%, or even if you're drawing a pension and it's 0, then that credit is refundable.
Okay. So this is the really powerful thing, isn't it? That I was just trying to get it up here in the Selfwealth portal. You can see dividends and you can see all these other things. And franking credits are kind of like that free kick for a lot of folks. And I think that once you've experienced it, you know what it's like, because it doesn't actually, it's not like a credit appears in your bank account. Yep. It's stored against your tax file number at the ATO, which means that for a lot of people, it's kind of like not a very tangible thing at first.
It comes in once a year, which is a challenge.
Yeah. But you've effectively got to set up, make sure that when you apply for your Selfwealth account, that you've put your tax file number in, and when you got the share registry, which might be, the share registry depends on which shares or ETFs you buy, make sure that your tax file number is recorded there as well, and your bank accounts are set up correctly, you've got the right details, and then that will automatically flow through to the ATO when you do your tax return. And I'm just showing the screen here, Drew, of Selfwealth, and you can see this is Wesfarmers. It's got a dividend, most recent dividend of $1.85. You can see the last dividend payment, the individual payment, because it pays dividends twice a year, was $1, which equates to a yield of around 4% in total. A yield being the dividend, the annual dividend payments divided by the share price. So a 4% yield, which might not sound like a lot, but this is the key difference between, I guess, the dividends you receive and basically any other type of income, is dividends often grow quite quickly.
Definitely, and I don't think Wesfarmers has cut very often either.
No,
it's been a grower.
Yeah, that's it.
Grower.
Yeah, that's it. So I can actually bring that up inside Selfwealth here. I'll just show the viewers that you can see that over time it's been a very, very consistent dividend. In 2014 there was a $3.05 dividend, but throughout time it's always paid a dividend. Like in the history that we've got here, always paid a dividend.
And that's what you want when you're looking for passive income. So that it's a perfect example of a company that isn't overpaying, is still reinvesting in itself, growing itself.
Yeah,
and is, if you know Wesfarmers, I think we'll do that in the next session.
Yep.
It has multiple sources of revenue. So if one's not going well, the other ones do, and that's the way we think about building portfolios focused on passive income as well.
Yep.
You want multiple sources of income. So regardless of the environment, it's still the bank account's still ticking over.
You mentioned there multiple sources of income. So franking credits are for Australian companies.
Yep.
But something that people will be familiar with if they've tuned into our chats before or even read some of your stuff online, most of us think we'll have a 60-40 portfolio. That's what like academic studies are based on. 60% invested in just stocks and 40% in just bonds.
Yep.
Now, that's been shown over time that it's a little bit like, it might be like a quote unquote balanced or near balanced portfolio.
Yep.
But there have been times where that's been proven to be quite weak in its, like it's simple, but it's maybe a good starting point.
A few groups use it as a reference portfolio. So
that's like a benchmark against.
Yeah, like I think the New Zealand Super Fund says here's a reference portfolio. It's a 40-60 in all the indices. So it uses the S&P 500, it uses the global bond, and that's just a comparison to check whether the decisions they're making are doing better than if they did nothing.
Okay.
I feel like that's a pretty powerful use of it.
Yep.
And then there's a tendency in investments to overcomplicate. So we try and that's the simple. Yeah. There's incredibly complicated. We try and sit somewhere in the middle, hopefully on the more simplified side, because you can get so granular when it comes to investments, and try to pull multiple different triggers and predict the future. But I think a lot of it is about minimizing mistakes and the impact that mistakes have, rather than trying to get everything precisely right all the time.
That's something actually you've taught me over the years, is that it's in good long-term investing is not about shooting the lights out. It's actually about avoiding risks. And a lot of people say that, like a lot of professionals say that, a lot of authors say that. You read that in a lot of investing books. The first port of call is risk management.
Yep.
And it's all, there's an old Buffett cliche. Have I said Buffett twice already in this recording? There's an old Buffett cliche of, rule number 1 is don't lose money. Rule number 2, don't forget that rule, basically. Because it's harder to compound once you lose money. You have to make up so much more ground off a smaller portfolio.
Definitely.
To get back to that point.
It's like if you fall 50%, you need to make 100 to get back to break even, let alone produce a return on top of it. And I think that's where all of our investments and the Atchison Consultants business we work with as well, it's very much focused on that. Protect capital first, and make sure when you're taking risk, you're being rewarded for it.
Yep.
And there's a tendency, in finance to try to predict the future and think we're smarter than other people, and it's pushing back on that and trying to. Someone said it perfectly, which is don't be precisely wrong. Yeah. If you're precisely wrong, you don't think you're going to be wrong, but when you are, that's when real capital destruction and pain occurs.
Yeah, I love that. One of the best investors that I know is a guy named Andrew Page, founder of Strawman. I think I might have mentioned him before.
Yep.
And he said he always says he'd rather be generally right than specifically wrong.
Which is, if everyone listened to it, then it would be a lot easier. But
absolutely.
There wouldn't be as many opportunities either, probably.
So coming back to the way you build a portfolio, right, a lot of people watching this will just think stocks.
Yeah.
Which is great. If you're in accumulation mode, it's probably where the majority of your money should be. Like if you're building wealth, like the stock market has proven to be a wonderful place to invest over the long term.
Yeah.
But you, if I'm not mistaken, you basically cut it into 4 pieces.
Yes.
When you think about, like if you had a blank canvas, there's different components and different types of investments that fit into each one. Can you step us through each of those?
Yeah, sure. I think the key starting point would be to think that, or reiterate that the paradigm has changed. In 2022, investment markets have been flipped on their head.
Yeah.
So, term deposits 18 months ago gave you less than 1%. They're now giving you more than 4% for a year.
Yep.
Government bonds are now giving you between 3% and 4% after being negative last year. The S&P 500 is still down 20% from 12 months ago. So literally every asset class is more attractive than it was 12 or 18 months ago.
Most people think the opposite though. Most people think shares are down, therefore bad.
And this is a natural reaction. Is it recency bias or I think recency bias is the perfect one where, we've seen a lot of people moving out of government bonds because they've fallen when you should actually probably be considering moving into them at the moment. I think you might have been one of them, but
yeah, indeed.
It's pretty simple. We still think about defensive and growth like you would a 40-60, as you said, a 60-40. So the 60 being growth, the 40 being defensive.
Yep.
And then we break that down a bit further because we're seeking to build portfolios that are immune from major events or aren't overly exposed to any a pandemic or a GFC, and we call them alternatives. So we have a defensive and then a growth alternatives bucket or sleeve, whichever you want to call it. Mm-hmm. And the defensive bucket has been hard to invest into for the last 2 or 3 years. So cash, term deposits, money market, so like high yield bank accounts, government bonds, as close to, and this is difficult to say on air, risk-free as possible or guaranteed. So you can still get government guaranteed term deposits, but you want incredibly low risk investments in there. And the way we try to explain the defensive bucket to clients is that if the share market fell 40% and stayed 40% lower for 10 years, we don't want to sell those shares at depressed values. So the defensive portion of your portfolio is there to be sold as required to fund any shortfall in your income during the period that equity markets are poor. Okay. We've rarely had to do that because I think if you're well diversified, you shouldn't have to be selling any levels. Yeah, exactly. But that's the kind of sleep at night portion of your portfolio.
Yeah. So that's interesting. I don't think I've heard you put it that way to me before. It's just like that is the backstop on your wealth.
Yeah.
Basically.
I think it's the most important way to talk about it too, because really, and that's what it's for, right? And then it drives what investments you hold in there. If you think, I want this to be worth $1, this asset to be worth $1 regardless of what's going on in the economy, well, there's only certain assets that will fall into that bucket.
Yeah, true. How about then this other thing, which is like, so you've got defensive, pure defensive alternatives, which are like, it seems to me, which I know what they are, but I think maybe an example here would help people as well. Can you describe what defensive alternatives mean?
So an alternative asset is basically something that doesn't perform similarly to, say, the government bond market or interest rates, or it's less exposed or less correlated, so it doesn't move the same way as major asset classes. The key ones would be bond markets and equity markets because they're the biggest portions of portfolio. So you're looking for non-correlated returns. Meaning
they don't move in the same direction.
Yeah, hopefully they go the opposite or at least don't move the same direction as much as that asset. And when we're looking at defensive, our view is that they have to have, the risk of or the potential volatility and the risk of loss. It couldn't be any more than, say, 6 to 8% of capital in a given year.
So you would study like historical results and see what was the...
Yeah.
Is there anything... I'm going to just flip on the screen here. Is there anything that's ASX listed that might fit into this bucket? Just as an example, not a recommendation, but just as an example. Like, is there like hybrids?
I think like
or even like income producing funds, like credit
LITs.
funds?
So like some of the LITs that are listed would be maybe Newberger or Metrics.
Yeah, let's see if Metrics, I can find Metrics here.
Yeah.
Metric Income Opportunity Trust, Metric Master Income Trust, MXT.
MXT would be probably an example.
Yeah, okay. So I can see that here inside Selfwealth, which is quite interesting. Yeah, cool. So because this is the thing, a lot of people don't realize you can build, it's not just stocks that you can buy via the stock market these days. Via these trusts and these ETFs, you can buy many different things, which is great when you think about it. Okay, so I'm just looking at the results here, Drew. I can see like over time, over 5 years, it's very, very flat, with probably the exception being during like the COVID pandemic where it takes a bit of a hit. But it's still, compared to stocks, it's less volatile, it seems.
Yeah, definitely. And I mean, we don't consider it to be traditional fixed income because it is slightly higher risk. And I think most of the bonds in there are lower credit rated than government bonds.
Yep.
But it's highly diversified. Essentially, it's a private, it's a non-bank lender that's making loans to I think about 200 or 300 other companies.
Okay.
And the aim there being private loans, they're not traded on a daily basis, and you're forced to hold them until maturity, so they're less volatile and they provide consistent income, and that income is generally higher than what you can get in cash and term deposits because the risk is slightly higher.
Okay.
So it's probably a reasonable example of a defensive alternative.
And how about then? Have you got anything else to add on defensive alts? Because it's going to move on to growth.
No, that's fine.
Yeah. So we've got defensive, which is the backstop. You've got the defensive alts, which you're looking for things that don't have that what we call huge drawdown. If you're watching and you're thinking, what is this? Like when you look at a performance of a ETF or a stock or a managed fund or really anything, what we call drawdown is when, like, if you take the biggest fall in the value of that investment, we look at the drawdown and we say, how risky has this been historically? Which is more, I guess that's more of a realistic view of what is the risk of an investment. Like a lot of people talk about this thing called volatility, which is the random ups and downs. But when you're building a portfolio, you want to look at that drawdown risk and you want to see how far has this thing actually fallen? Because I'm most likely to make a mistake when I'm under the pump and I'm feeling, well, my thing's down 20, 30%. That's the real risk, I think, when it comes to portfolio construction. Like a lot of people take that for granted. So there's the two parts of the portfolio there, defensive and defensive alts.
The challenge is every crisis is different too.
That's it, every time.
Different alternatives work different in different crises.
Yeah, I can't remember who said this time it's different, the four most dangerous words in investing. But this time, everyone says this time it's different. Okay, so how about then, obviously, the growth side, which is the fun stuff, I think, for a lot of people. This is like where you got stocks, ETFs, I imagine, Aussie.
Tends to cost more as well because funds. It's fun. Yeah. So the fees on these things are usually higher.
As in like the funds themselves or the ETFs or whatever, or the listed whatever it is that you're investing in.
Yeah.
Is that because the returns tend to be, like the disparity in returns also tend to be higher?
The target returns are higher. The asset, the broadness is higher. They usually require bigger teams, I guess, to invest. And then you're talking about most of the things in the defensive alternatives are more likely to be lending and credit driven, whereas most of this starts to think about equity markets and
growth and that sort of stuff.
Yeah, exactly.
So just some examples, I guess, that would fit into here. We've got a video coming up on this, by the way. So we're going to show you exactly the things that might fit into different parts of the hypothetical portfolio. But even though we say growth can produce a lot of income too.
And we, in a lot of the events, so we're doing an alternatives event in a few weeks' time.
Yeah.
And a big focus of the advisory committee, which is other leading advisors, is that alternatives need to focus on providing income. Not like historically, alternatives, all you thought about was private equity and venture capital, and provided little in the way of income, if any, for 5 or 6 years. But more and more advisors and investors want consistent income from their alternative investments. So
this is the growth alternative investments. So I feel like that's interesting. What would be an example? So you had before like the Metrics fund, which seemed to be more, it's not quite, it's not government bonds, it's not something like that, but it's looking and feeling like that just in a different way.
I think a key here is that depends on how much, if you've heard of the concept of a fee budget. So a lot of people
Can you explain that?
So yeah, of course. When we build portfolios and when sort of advisors or institutional investors build portfolios, they'll think about what is the total level of fees that they think is appropriate for the investment managers for the investment management fees for that portfolio. So a fee budget, reversing it, Australian super charge, I think it's 0.73%.
Yep.
That would be that not necessarily their fee budget, that's the fees they charge. So a fee budget would be in comparison to that.
And they're the biggest superannuation fund in the country.
Yeah. And that's just the fees paid for investing, not for any other advice.
Not for the admin or the member advice or the insurance.
Exactly.
That's really important for people to separate. Actually, just this is a digression from the conversation.
Yeah.
But if you are looking at your super statement, it's important that you differentiate between things like insurance, the member fee, which is sometimes like $2 a week or something like that, and the actual investment fee. Depending on which strategy you choose, if it's balanced, growth, conservative, your fee will change.
We're often compared the fees we quote to Australian super, but our fees obviously include strategic advice, ongoing advice,
financial planning,
superannuation, estate planning, and
customer
investments.
Service.
So it's always important to split those out. And I think the challenge with alternatives is if you've got a low fee budget, everyone wants to, the proliferation of ETFs has been driven by low fees.
Yeah.
If you don't want to spend too much, your range of alternative assets is quite restricted.
Yeah. Because that's where it gets expensive.
Exactly.
Yeah. Okay.
So things like in the lower cost infrastructure, commercial property, so less the things that have proven to be less less volatile and less correlated with the S&P 500 or the ASX 200.
Yeah.
So it's infrastructure shown to have lower drawdowns, performs reasonably well in periods of inflation. So that's like a quasi alternative where its income stream and its returns won't be directly correlated with what's going on in the share market. And then it gets more complex and you start to go into, say, private market infrastructure. So you can own part of Melbourne Airport. You used to own Sydney Airport, but not anymore. Or you can own unlisted infrastructure assets that have far less volatility because they're only valued on a quarterly basis.
So like things like, it just as a listed version, like an ASX listed version, would the ASX listed version be something like Transurban?
Yep.
So for those of you that don't know, this is a company that's on the ASX. You can buy this. The ticker symbol is TCL. Transurban is, I think, the biggest owner of toll roads in Australia. And it's very common in infrastructure funds. So you can get managed funds that are set up or ETFs that are set up just to invest in this type of thing. With the idea being that, like you said, the income stream is consistent. Like people are still driving on toll roads, whether the stock market falls 10% or 15% or goes up 20%.
I actually think autonomous cars will give them more traffic as well recently. So, but it's driven by usage, not by what's happening in the share market.
Pun intended.
I'm never good at puns.
Pun intended.
And on the growth alternatives, it expands into other things. So hedge funds. So a hedge fund is you've seen them on the ASX. It could be people that take a macro view and say that China looks better than the US or bond markets are overvalued, and they'll do long and short positions in different asset classes. Mm-hmm. It could be a long short equity strategy. So I'm sure you've met maybe Nick Griffin, who runs Munro.
Munro Partners. I think they're on they're ASX listed as well. I think they've got a fund on the ASX.
So their main fund is a long short strategy, which means they'll take short positions sometimes to protect their portfolio, sometimes because they think a company is overvalued. And we see that as alternative because the return stream from that will be different or should be different from what the share market itself is doing. Yeah,
I've just got this up here inside Selfwealth. Munro Global Growth Fund. MAET is the ticker symbol here. Nick and the Munro team are quite impressive, and so that's like a long short, is it?
Yeah.
Meaning that it can invest for growth and going up, betting on upswings, but also bet on if things fall.
Exactly, and then hopefully your drawdown should be lower when, as you were saying, you shouldn't fall as much as the market when the market falls.
Yep, cool. I like it.
Probably one of our most successful has actually been holding farmland. In a diversified, leased farmland, in a diversified fund for about 10 years.
Oh, wow. Okay. Yeah.
So it's yielded something like 14% for 10 years, and capital growth has been like close to 100%.
Wow. Wait, so how is this held?
In just an all managed fund structure.
Oh.
Yeah.
Oh, wow. Okay. That's really interesting.
But that's alternative. So it's completely leased property. So you're not taking, seasonal or production risk.
Yep.
And you're just getting lease payments. And it's just lease payments from a different portion of the economy than if you, say, owned Vicinity or SCA, so shopping centres or farmland. It's just getting diverse range of sources.
Yep. Vicinity being the shopping centre business, it's listed on the ASX. VCX, I think, is the ticker symbol.
SCA Shopping Centres Australia.
Yep.
The easiest code on the ASX, I think.
So just in summary here, Drew, we've got basically the 4 parts of the portfolio: defensive, a backstop, defensive alternatives, non-correlated, but still like often income producing and that type of stuff.
Yep.
Then we've got the growth alternatives, which are things that are designed for growth, but will pay income as well. We're hoping to see more income from them.
Definitely. And then it falls outside of traditional private equity and venture capital, which is going to be restricted to some people as well.
Yep. And then finally, we've got the one which we all know, which is the growth part of the portfolio. That's just direct stocks.
I skipped over that, didn't I?
Yeah, but then that's fine. Like we talked about a little bit, is the growth element of the portfolio is Aussie shares, international shares. It's interestingly, I know this, that you've got property in there, listed property. So not your home,
but
the property plays on the ASX. Will that include things like REITs?
Yep.
Real estate investment trusts?
Yeah, definitely.
Unpacking the jargon a bit there.
I think when it's less diversified, if you're buying a single REIT, where we treat it more like an equity than if you're buying a diversified portfolio of REITs and properties, then it looks more like an alternative income stream.
Because the VAP ETF, which is from Vanguard, VAP in your Selfwealth account, is it's an ETF that invests in real estate trusts.
Yeah, exactly.
So that's more diversified.
Yeah,
Whereas
somewhat,
even though it's all property basically.
Yep.
Whereas if you buy just one individual REIT, say like BWP Trust, ticker symbol BWP.
Just getting Bunnings stores.
You just get Bunnings basically.
Yep.
They own the properties behind the Bunnings stores.
So we view that more like equity than if it was highly diversified and had 15, 20 holdings in it.
And that's because, so you viewed that more like a true growth thing because rather than any other type of bucket, because it will move like stocks.
Even more. It could move more than the market as well.
Yeah, because there's so much debt in those properties. Is that right?
Yeah.
So you get the debt, but you also get it's on the stock market, so people are like a frenzy.
Exactly.
Up or down.
You sell everything when the market's falling. So
well, that's something that we hear as we look throughout 2023. That's something that people are really concerned about is property prices.
Yeah.
So it would make sense that they're more volatile.
Definitely. I mean, most of them are down 15 to 20% from their recent highs, but the value of their assets hasn't changed yet. So
because that probably will fall down eventually.
That's what the market's trying to say, is that the valuations will be lower.
Because interest rates are higher, because people are worried about retail and that sort of stuff going forward.
Yeah.
Yeah, which makes sense. Okay, so we've got the 4 buckets there.
I think the key on the growth one also is balancing income and growth. Like just investing for income, we've probably talked about before. If you invest in a company that just pays out 100% of its profit as income.
Like Telstra did a few years ago.
It's like a bond. It can't grow. It's more likely to be losing money and not necessarily a good investment to be continuing to allocate capital to. You're probably better off buying something that's Woolworths that yields half as much, but is growing its earnings, deploying capital into growth businesses, and is able to deliver a higher dividend over a period of time.
So inside your Selfwealth account, what you can do is you can go and you can look at the dividends over time, and that's DPS for short, dividends, and that's dividends per share. But you can also look at something called EPS, which is earnings per share. That's the profits broken down on the per share level. And if you compare those two, what we're trying to say is you compare how much is paid out in dividends versus what they earn in profit. Now, if they're paying all of their profit out as dividends, then they're not leaving anything for themselves to grow. So we want a sustainable level. And we'll talk about that in the next installment of the passive income series where we go through a few ideas. Drew, so let's just say in these buckets, I think an obvious question might be, well, what would a balanced portfolio look like across those 4? Just hypothetically. Obviously, you'd do a risk profile, you'd do objectives, you'd speak with your clients and all that sort of stuff. But just in a very general sense, what would be balanced?
I think if you asked me 12 months ago, it would have been like 30-70 or 40-60.
What do you mean
by that? So 30% defensive, 70% growth.
And when you say growth, that is growth and growth alts and defensive alts.
Exactly. I think usually depending on the client, the alternatives will be the smaller allocation within there. So you might have, if it was 30 defensive, you might have 20 in traditional and 10 in alts. And it might be 55 and 15 in growth and growth alts.
Okay, so it's not a huge amount in those alternative buckets.
Well, generally no as a default, but depending on what each client requires, and if they have more than sufficient capital, you're more likely to introduce alternatives because they have less volatility and they don't need to accept as much volatility to generate their returns.
But they typically require, other than the stuff that we've talked about here in Selfwealth, like Monroe and all that, they're typically also not always on the stock exchange and require a higher balance.
Exactly.
Yeah. But you can access them as a financial advisor.
Yep.
You can access them through like platforms and that sort of stuff, right?
Yep.
Yeah. Okay. So that's great. So we'll come back to that in just a moment. But can you talk to me a little bit about, just before we get back into like what does a balanced portfolio look like, can you just talk to me about these 4 buckets? This series is about income. Roughly, like we're not going to hold you to it, but just really roughly, what has been typical in terms of income generating from these different parts of the portfolio?
Yep. So asked me 12 months ago, it was 0 for defensive.
Yeah, because bonds were nothing. Term deposits were nothing.
And then you lost 15% of your capital if you're holding a lot of bonds back then as well. But
you weren't invested in bonds then, like traditional bonds?
Now, we'd been out of traditional, what they call long duration bonds for the last 2 years because we saw bond yields were under 1%. Clearly, interest rates are going to have to go up at some point. I didn't think inflation would be as bad as it was, but I still thought interest rates would have to go higher.
Yep.
And if interest rates go higher, bond prices fall, and most are down 15% in 2022. In terms of income, the easiest way to think about it is cash. You can now get about 3.4 or 3.1% of the RBA cash rate.
Yep.
Bonds, you can get anywhere from 3.5 to 4%. Term deposit, you can get about 4% for 1 year. So I'd expect at least 3 to 4% income from your defensive allocation.
Yep.
Before considering inflation or anything else, but 3 to 4% from your defensive low risk allocation at the moment.
Because that's what the government's offering.
Not trying to make any.
You're not making any assumptions. That's literally what it says.
Yeah, just providing a broad range.
Yeah. Okay, what about, so defensive alternatives, I've spoken to over the last 12 months, I've spoken to a lot of fund managers that operate in defensive alternatives. I just find it fascinating.
Yep.
What's the range?
It's amazing how interesting debt can be.
I know. I always thought it was
Equity's
really boring because
like,
it seemed complicated. But the more I learn about it, the more I'm thinking, wow, this is really interesting. Like for an income source, like some of the stuff that I learned in 2022 was like, this is incredible. I didn't know this thing existed.
It's why the best equity investors tend to come from fixed income.
Yeah, because that's true. I've found that too. That the best investors and analysts and all that tend to start in bonds or like that side of the world, and then slowly move their way across into equities or shares and be like, this is a lot easier.
Definitely.
Yeah. So what in that bucket, which is that smaller bucket around alternatives, what would go? How much? Like, what can we expect?
I think the range is a lot broader depending on the risk because you're starting to talk about lower rated bonds.
Yeah.
I generally say anywhere from 200 to 300 basis points, so 2 to 3% above defensive is what you'd expect on average.
4%, you might say
6 to 7.
6 to 7%. Yeah.
And that's just reflecting the higher risk you're taking.
Yep.
But within that, there's a broad range. So there'll be some things that are yielding slightly higher than government bonds, 4 to 5. But then I think you met with a group like Invesco recently.
Yeah.
And that's yielding something like 9 to 10% now.
But there's more risk.
Yeah. Exactly. So you got that range of some things 9 to 10, some things 3 to 4, and that comes back to something like 5 to 6% or 2 to 3% above very low risk.
So this is where it starts to make sense for me why you would not just be doing stocks and bonds.
Yeah.
Like some of the Vanguard funds just do that, just stocks and just bonds, which misses probably a big opportunity of this huge middle bracket. It seems to me, that's my opinion, love Vanguard. So full disclosure,
we all do.
Yeah, we all love Vanguard, but that's probably where those default options probably lose out a bit of scope.
And a lot of that's cost driven. You can't have a super low cost portfolio and have good alternative diversification because alternatives are all going to cost a bit more, even in defensives.
Because they're more complicated to build those strategies and they cost more money.
And they're more niche and they're in sectors where active management tends to have the ability to pay off.
Well, yeah. Okay, so we're looking for, say, 2 to 3% on top of the 3 to 4% from the defensive bucket.
Just to reward you for the risk you're taking.
How about then, like the growth side? So we've got the two growth sides. Is that, like, do you lump them together? How do you think about the income from those two buckets?
Aussie equity is pretty straightforward. Usually, I think the market's about 4, but that includes a lot of small.
And plus franking credits.
Yeah, our approach has always been, given we work with retirees and decumulation, we don't really stray outside the ASX 100 most of the time.
Yeah.
So if you're sitting there, you're more likely to get 5 on average, plus franking. which usually takes it up to, I think, is that 7 point?
Yeah, probably about 7%, 7.2 or something like that. Yeah.
Including franking. And being primarily retirees, then you actually get the full benefit of that franking just once a year, which a lot of people forget.
Yeah.
That's why tax returns are so, Are my tax returns done yet? Is always the big question. Yes, most of them are done.
Yep.
Global, you're getting 1 to 2% yield.
With a lot less because I don't have the franking credit system. The companies tend to be more growth focused, that sort of stuff.
And there's a lot of confusion around if you use managed funds to invest overseas. How do I predict the income from my managed funds? Well, they're not most of what you get is an income. It's realized capital gains that are being repaid to you.
That's actually a really important point that I'm just going to labor on this just for a second.
Yeah.
A lot of the investment management industry is built on talking to you as if you pay no tax. So they talk to you as if there's a 7% return and 7% return. But no, you've actually got to pay tax.
Yeah.
If you're accumulating assets. Even in retirement, there may be instances where you pay tax and you need to think about that. So what you really want is you want to know how things are taxed. In particular for managed funds and ETFs, they're trusts. So all of the capital gains tax and all of the income has to be passed back to you. We've talked about this in a Selfwealth Live episode where we talked about listed investment companies versus shares versus ETFs. But that's a really important consideration. We probably won't spend too much time on tax. Your accountant can help you with that. Back to you, Drew. Growth, income.
And I think the key, which we'll keep stressing on, is the importance of sustainable income. I've seen a couple of studies. It might have been Roger Montgomery did one where he compared CSL and Telstra over 15 years.
Oh, right.
A company that reinvested in itself versus one that didn't. And CSL's dividends consistently grew. Telstra's have basically been paying same for 10 or 15 years.
It even cut it.
It had to reset at some point as well.
Yeah.
Whereas CSL just ticks along and then you watch the share price of one versus the other as well.
Yeah.
Obviously, there's a lot of other
variables.
Inputs and variables into that, but it just shows you that you want growing companies paying growing dividends. And just because a company's not paying an 8% headline dividend doesn't mean it's not worth having within your portfolio. I think you might have met, is it Martin Curry?
Yeah, Martin Curry. Yeah.
Their entire business, I think their entire concept was driven by him building portfolios for his parents that sold their business. I think it was Martin Curry. And on that basis, you want sustainable growing dividends in retirement. You don't just want the highest one from the previous year.
Okay.
And then income from growth alternatives is probably more challenging.
Yeah.
If you're on the more liquid side, so you're not including things like private equity and venture capital, then you're likely to get probably 3 to 4% income, but a larger portion of growth. So to be the opposite of most of the other asset classes.
Okay, great. So let's bring this home for folks then. Overall, what do you think is a reasonable amount of income, sustainable income from a portfolio over time? For every $100, how many dollars can you extract? Like there's that old rule of, there's the 4% rule.
The drawdown rule.
Yeah, which is that it's often called the safe withdrawal rate.
And that's very much driven by US experience too, isn't it?
Yeah, it's more US data, which suggests, by the way, that
solves to zero.
Yeah, you can basically get a 7% return. This is the logic behind the thing. Minus 3% inflation, which is what most of the central banks are trying to get to for inflation, gives you 4% in real terms. So that's the real income that you can sustainably draw. But obviously, that is just a very broad rule. Not every year is 7%. Sometimes it's negative 7. And sometimes inflation is a lot higher. So you've got to kind of average it out over at least, I'd say, 10 years. But what can realistically, as we go into 2023, what is a realistic amount of income?
I think 5% from a truly balanced portportfolio is realistic.
I guess when you think about it, 4% from bonds, if you can get that,
it changes the paradigm. Like I sound like a broken record. It's significantly changed, and the more you can stress. That's why we like focusing on education, because people wouldn't be deploying money into lower risk asset classes if we didn't keep talking about how much more attractive they become.
Yeah. Well, the thing is, like, there's ETFs on the ASX that offer, like, they're bond ETFs. Like, there's the IAF ETF, which is a bond ETF. There's a heap of them. There's VBond, which is VBND for global bonds. Then there's things like AAA, which is just a cash ETF, which just goes and finds the best term deposit. So there's multiple ways for you to get the income really simply now.
Definitely. And, I think it would, if you're looking at asset allocation now, you can take significantly less risk and still get the 4 to 5%.
Which is like, Drew, we're around each other all the time, so we talk about this all the time. But for people that might be tuning in for the first time and hearing this, what this basically means is now might be a better time to build a portfolio than ever, like ever in your experience, because stock prices are down, a lot of prices are down, but at the same time, interest rates are up.
Yeah.
And sure, we might have a recession.
There's always uncertainty.
There might be things going on overseas. The currencies might do this, prices might do that, and we don't know what happens 1 year to the next. But over the long term, 10 years.
Even so much better than 12 months ago, 18 months ago, 2 years ago.
So if you are interested in building a passive income portfolio, I mean, now is a great time to think about doing that. One final thing I might ask here, Drew, before we maybe wrap up today's session, which is just that, can you tell us where people tend to go wrong? So a lot of people set out with this wonderful goal, and we have people write into us every week and say, and I have these ideas and here's how it went wrong. And even here on Selfwealth Live, every week when we tune in at 6 p.m. on Wednesday night, people write in, they say, great, this is wonderful, but I made this mistake. And we all own up to it. We all make mistakes. But in your experience, having done this for 17 years, like in your team, you've got decades of experience.
Yeah.
So it's not just you. Where do people tend to go wrong on that journey?
I mean, the big part we see is on the emotional side, and that's focusing, linking the dividend payments you receive to the lifestyle you can live in any given year.
Yep.
So a Telstra dividend's down, I can't go on that holiday anymore. That is just like you spend your entire life saving for retirement, and then you're worried about what a company that is out of your control is paying as a dividend to determine how you live. Yeah. That's one of the biggest things, and part of that's shown in people focusing on the dividend yield and only buying the stocks that are paying good income. Because you capitulate. It's almost capitulation, because you end up allocating your portfolio towards more companies that are unlikely to grow their dividends, and kind of making, snowballing and making the challenge worse.
Yeah.
That flows into the second one. Probably harp on this too much, which is naive diversification.
Okay. Where
people think, I hold 4 banks, I've only got the ASX, I hold 2 resource companies, and CSL, I'm diversified.
Yeah.
There's just too few single drivers. I mean, we think of diversification probably 5 different ways. So the capital stack of a company.
So like as in debt, if you're owning the debt of a company, if you're owning the equity, that's
don't just buy the equity. So on the ASX, think about buying the debt. Maybe that's hybrids, maybe that's bonds, maybe that's term deposits.
Yep.
That's also in the capital stack.
Yep.
Sectors, so making sure your income sources are in different parts of the economy. It could be agriculture, it could be manufacturing,
resources,
infrastructure.
Yep.
Always diversified. Geography. There's very much a home bias, particularly for retirees.
Yep.
So making sure the way you have more confidence in your income is that you make sure it's coming from economies that are in different position to what you are, to what Australia's doing. Asset classes, naturally, similar to the capital stack. And then economic drivers.
So that would be like...
Don't be all floating rate. Don't be all fixed rate.
So don't be all betting on interest rates going up or down. Don't be all betting up currencies doing this or that.
Yep.
Making sure that... Basically what it sounds like is make sure your portfolio doesn't break.
Exactly.
Like prepare for multiple futures.
And don't bet your base case on... Don't, bet the house on your base case coming true. Because we found that pretty much no base case ever comes completely true over a long period of time.
Well, this is it sounds too sensible to be true. Like it honestly does.
Yeah.
But we always get swept up in the emotion. Like the last 5 years, like before 2022, if you try to convince someone that to have bonds on your horizon, maybe not in your portfolio, but people would be like, no way.
Yeah.
Because why would I do that? Look at the last 10 years. It's been terrible or whatever.
Now all the capital flows are going to bonds.
Now everything's going back into bonds.
Yeah.
So you've got to prepare yourself and your portfolio to be ready for that.
And that's the role of an advisor as well, to be able to step back.
True.
I think you did a few sessions on financial media.
Yeah.
That it's so driven by fear and greed that it makes it difficult to make sound decisions.
Yep.
Like a 50 billion lost on the market. Well, it's irrelevant because the market's worth over $1 trillion.
Yeah.
But it still forces people feel forced to make decisions when they shouldn't be.
And that's it. Yeah. That's another one for the law of big numbers.
Yeah.
Big numbers sound scary.
Exactly.
We lose the zeros when we go like that.
I read a book that talked about, I think it was the US government and they forced people to write out all the digits for like 50 trillion because it scared people and forced people to actually listen.
Yeah.
But yeah, it's just extra zeros.
Yeah, it is. Okay, so the first 3 ways people go wrong with building a portfolio is, one, we've got just focusing solely on the dividend yield and just somehow anchoring your lifestyle to that. Like, that's a mistake. You mentioned all the different ways you build a portfolio that insulate against that. The second one is naive diversification. Like, if you are overly exposed to any one sector, please really think about that. What's the third one?
Focusing too much on the short term.
Okay.
So even a retiree that comes in their 60s, people forget they have at least 30 years.
Yeah.
To get dark, mainly, usually the male it's just longevity, and it's the life expectancy. But the male will pass away, and the wife will generally live an extra 5 or 10 years.
Yep.
But you're looking at least 20 to 30 years. So why are you making short-term decisions based on the next 3 to 6 months when you should be thinking at least 15 to 20 years into the future?
Yeah.
And when you start to think about that, that's where asset allocation becomes more important, staying exposed, ensuring you're still benefiting from compounding even though you're drawing down.
Yeah.
So kind of reverses the way you think about portfolio construction.
Yeah, I like that. That's another thing. You're at the coalface with retirees. A lot of people think, I hit retirement, therefore I'm not focusing on growth. I'm just going to basically just not even think about that. It's just going to be super defensive. And then they miss the big opportunity to extend the duration of what they've got and then what they've made for themselves.
Exactly.
So that's fantastic. So focusing too much on the short term. And a lot of the stuff that we've spoken about today, by the way, is most likely based on information that would be over a 5, 10 or 20 year horizon. We tend to focus on ultra long term because that's what we're focused on. So just to recap today's session, or tonight's session, I should say, it's a bit hard to tell when you're here inside the studio if it's day or night. Passive income is like interesting study from Drew that said that, for the last little while, growth had dominated, but maybe now it's time to focus on the income. Like, getting income from a portfolio now, using a brokerage account like Selfwealth, if you want to diversify away from your active income and you want to truly build a diversified portfolio, it's easier. It's easier than ever, and now might be one of the best times, at least in the past decade, to do that.
Definitely.
So think about that. Franking credits, free kick. Drew talked about the 4 buckets being defensive alternatives, growth, and growth alternatives. There are now options available via the ASX. That's probably the first time that they've been available. Like the last few years, these are all coming to market, which is very, very good for people that want to build their own portfolio. You talked about what you can expect from the different income sources now. Obviously, that will change in time. What a balanced portfolio looks like, and the 3 ways that people go wrong. We covered a lot. For the first session, passive income's a lifetime.
Exactly, yeah.
So we try to cover a lot in the first installment of this series. The next series will focus on some stocks and ETFs that you can actually put into the portfolio and how you can think about these things. We're going to cover things like dividend ETFs, standard ETFs, managed funds, direct shares, all these different types of things. We know you love them all, so we'll be covering those with Drew. Don't forget, in coming weeks, on the 25th, we will have just an out-and-out Q&A session where we'll be live talking to you and answering your questions. It's going to be heaps of fun. But in the meantime, if you want to get in touch with Drew, you can head to wattlepartners.com.au. Don't forget, if you're joining Selfwealth, or you're referring a friend to Selfwealth for the first time, they can get some free trades. So go and check that out. Just ask the Selfwealth team at selfwealth.com.au about how you can refer a friend and you can win. And also investing for kids. It's a new year, new me. Invest for your kids. You can do that very simply via Selfwealth. Just follow the setting, jump into the settings, and you'll see the prompts to set up a minors account. There's also a fantastic blog on the Selfwealth website. Drew, wow, heaps of fun. Looking forward to the next episode.